If you think yesterday's market action was just a normal pullback, then you're seriously underestimating what actually happened. In the past 48 hours, crypto went through a chain reaction of blowups. The Bank of Japan suddenly turned hawkish. Treasury yields bounced higher again, and all of this hit right when U.S. equities were sitting at elevated levels after a huge run in November. That red candle you saw yesterday might look like a simple retracement, but it was basically a cross-market stress test. The real question is this: was it a short-term emotional flush, or the first warning sign of something bigger? Before the market opens today, let's break the whole thing down. Hey everyone, I'm Steve. Yesterday's session was much more complicated than the index numbers suggested. It wasn't a single headline that dragged the market down. It was three forces combining at the same time: the systemic issues emerging in crypto, the Bank of Japan's sudden hawkish turn, and the rebound in treasury yields. And remember, all of that happened while U.S. stocks had just finished a month-long rally with crowded positioning and clearly overheated sentiment. So yesterday wasn't just a dip, it was a cross-market chain reaction. Let's break this down layer by layer.
The first domino, without any doubt, came from crypto. Over the last 48 hours, the crypto market basically experienced a mini systemic shock. YFI was hacked, with about 1,000 ETH stolen. And that's not some random small project. That's a core DeFi protocol. Then Upbit reported another security incident. It wasn't the size of the loss. It was the psychological message it sent. Is the entire crypto infrastructure unstable again? That fear hit much harder than the numbers themselves. And then the leverage unwind started. Billions of leveraged long positions were liquidated in rapid succession, close to $1 billion in liquidations over 24 hours. Bitcoin broke below 84K, which wasn't just a random level. It was the main 3-week distribution zone. Once that level cracked, every algorithm, every risk engine, and every systematic strategy began selling at the same time. That's why the drop felt so violent. On top of that, ETF inflows, which were extremely strong last week, suddenly dried up. Institutions stepped aside. Liquidity evaporated. Risk exposure was cut everywhere. When you combine security failures plus leverage wipeout plus ETF buyers vanishing plus a major support break, you get a full sentiment reversal. Crypto is one of the world's fastest risk indicators. When it collapses, everything else feels it, especially U.S. equities.
So the sell-off you saw in U.S. stocks yesterday didn't originate from U.S. stocks at all. It was crypto's panic bleeding outward. This kind of move feels sharp and messy, but it doesn't automatically mean a lasting trend change.
The second shock came from the Bank of Japan, and this one is way bigger than most investors realize. For more than a decade, Japan has been the world's supplier of cheap capital. Countless global funds use the same approach. Borrow yen at low rates, buy treasuries, tech stocks, commodities, even crypto. This is the foundation of the global carry trade. But then yesterday, the BOJ hinted that a December rate hike is possible. That single comment took the implied probability from under 30% to nearly 80%. That's not a remark, that's a shockwave to every long yen short everything position in the world. So what happened? The yen surged. Japanese bond yields jumped. Anyone short the yen was forced to cover, and leveraged global positions started getting trimmed. Carry trades don't unravel slowly. Once the math stops working, you must unwind immediately. Why did Bitcoin get hit first? Because among all risk assets, it's the easiest to liquidate instantly in size. Once BT sold off, everything else wobbled. The BOJ's shift basically told markets the cheapest funding pipeline in the world might tighten. And that's a funding side problem, not a sentiment side problem.
And that's why yesterday's sell-off looked chaotic, but still had a clear logic behind it. It wasn't a fundamental break. It was a short-term liquidity squeeze.
Now we move to the third force, treasury yields. For 2 weeks, yields had been steadily drifting lower, giving the market room to run. Tech stocks surged, indices climbed, and everything looked clean. But yesterday, the 10-year yield bounced back toward the 4.4% area, and psychologically, that hit the strongest sector of the market, tech. Going into yesterday's session, investors had gotten comfortable with the idea that rate pressure is easing. The bounce in yields reminded everyone, we're not done with this yet. So the sequence of yesterday's price action made perfect sense. Early weakness from crypto spillover, a midday attempt to recover, and then late-day pressure as yields pushed higher again. But if you check the structure, SPX simply revisited the 5-day moving average. NAICS held above major support, and there was no panic-style volume spike. The entire pattern looks like a cool-off after an extended run, not a breakdown. The selling was measured, not the kind of forced liquidation you see before major trend reversals.
So yesterday's red candle wasn't the market saying we're done. It was the market adjusting its rhythm after a month of almost non-stop upside.
Let's widen the time frame a little. Historically, the first week of December is one of the most volatile windows of the entire quarter. Why? Because November is typically strong. Funds chase performance, managers take risk, and price gets stretched. Then in early December you usually see profit-taking, portfolio rebalancing, hedging adjustments, and lower liquidity as we head toward the holidays. This year is no different. Yesterday's weakness looks dramatic only because it overlapped with crypto panic, BOJ hawkishness, and a yield bounce all at once. But in terms of location, timing, and structure, it fits the usual pattern almost perfectly. The real question is not, why did we pull back yesterday? It's where did we stop? As long as SPX stays above 6,700, everything we saw is still in the category of a healthy retracement. The only truly dangerous scenario is a confirmed close below 6,700 sometime later. That would force us to reevaluate the medium-term structure. But above 6,700, it's just digestion after a big run.
So don't obsess about how big yesterday's red candle looked. Focus on the level. Above 60,700 more us, normal correction. Below 60,700, we reassess.
Now let's talk about the fundamentals, the part of the market that actually matters. And this is the most stable area right now. First, rate expectations. The market is slowly pricing in a higher probability of a 25 basis point cut in December, and the new Fed chair's tone has been noticeably dovish. That's constructive for tech and growth stocks. Second, consumer strength. Black Friday numbers came in strong. Online sales hit a record, up about 4.1% year over year. Large retailers like Amazon and Walmart confirmed elevated order volumes. A stable consumer base acts as a floor beneath the entire market. Third, corporate earnings. Last quarter was the strongest earnings season since 2021. 83% of companies beat expectations, and total earnings grew nearly 14.6%. That's not cost-cutting growth, that's real operational strength. Put all these together, lower expected rate pressure, solid consumption, and rising earnings, and you get a market supported by real fundamentals, not just speculation.
And that's why even when external noise scares the market, the underlying structure doesn't just collapse, because the foundations, spending and earnings, haven't broken.
Finally, let's quickly look at stock-specific drivers from yesterday. There were a lot of headlines, but here are the ones that actually matter. NVIDIA taking a stake in Synopsys shows deeper consolidation in the AI ecosystem. But SNPS remains weak short-term, because its earnings and guidance were disappointing. Tesla got hit again, after M publicly doubled down on his short. And the stock is still capped under the 50-day moving average. Until it clears that area, it's stuck in a no-direction zone. MSTR's CEO said the company might sell BTC if necessary, which threw gasoline on an already panicked crypto environment. Because everyone knows MSTR trades like a leveraged version of Bitcoin. BMNR loading up on ETH is classic, treasury plus crypto leverage behavior. Great in a vertical bull market, dangerous in a choppy one. And SEAT got a bullish call from Morgan Stanley. But the entire memory sector is still dealing with heavy capex pressure. So oversold doesn't immediately mean reversal. These examples show that stock-specific moves right now are driven by flows and sentiment, not just fundamentals.
Let me close with the two things that matter most heading into today's session. First, yesterday's sell-off was triggered by crypto blow-ups, BOJ hawkishness, and a yield spike, not by U.S. fundamentals breaking down. Second, as long as SPX stays above 6,700, everything we saw is still healthy digestion after a big run, not the start of a major reversal. The real forces holding this market up, earnings, consumption, and easing rate expectations, remain intact. So don't let a noisy session rewrite the bigger story. I'm Steve, and I'll see you in the next one as we continue tracking the key levels and the next move in tech and the indices.